Hey, good evening, everyone. Marty Missouri here, November 16th, 2021, with a technical update for you. This evening, we're going to look quickly at the S&P 500. We're going to look at breadth for the S&P, for the NASDAQ in particular. We're going to check up on the dollar. We're going to look at some commitment of futures traders reports. We'll touch on silver and so on. And I'm going to actually do this in relatively short order, believe it or not. So we'll start with the S&P 500. This is a 3-year daily chart, so it's that one we keep working through. And folks, not a lot's changed. We have this this uptrend right here that if you come across the top, it makes a very long rising wedge pattern. We did break down through it here. That gave us a sell signal, broke down through the 50-day moving average. Struggled with it more than we have at just about any point this year, but then recaptured it. We see the 50-day moving average trying to slope back higher again. That's bullish. But notice that the actual index tested this uptrend line and resisted it right there. Again, folks, don't be the least bit surprised if we melt right back up through these levels right here. Again, really good seasonality in November and December. Maybe a different conversation when the calendar turns over going into next year for some of the reasons I've discussed with you. But, longer term, the bigger scheme of things, we still do have a bearish pattern up here. We have our bearish divergences on the momentum indicators. The MACD here on a short-term basis is threatening to roll over. You see the histogram moving down and give us a short-term sell signal. We were overbought here, already working that off a little bit, but trying to get there again. So, even in the near term, seasonality notwithstanding, this market looks a little heavy. But of course, these technical patterns, like I'll say every time, they do not assure you or me or anyone else, they shouldn't, that this market is about to come tumbling down. When it does come tumbling down the next time, it'll very likely be preceded with patterns like these, rising wedges or some other bearish pattern, and negative divergences on the momentum indicators. Remember back in here when we looked at this 2-hour chart, we had really bullish patterns. I said this is unambiguously bullish. Sure enough, we broke out of that. We started to get a little bearish look right in here. In fact, it was a bearish look. But I did say that this isn't as bearish as that is bullish, but it was rolling over. We did get a little bit of weakness in here, but then it just caught steam again. Now we've got something again, at least on this short-term chart, that looks pretty bearish to me, right? You've got this, it's kind of an ascending triangle more so than a wedge. You can see we've been bouncing on that resistance right there and really rolling over on these momentum indicators. So again, short-term stuff, but this would suggest that, maybe we go into the day tomorrow with little weakness. Okay, so those of you who read the blog every morning, you notice on quite a few days of late, I've been pointing to when the market's up, that the breadth of the market hasn't been so good. This morning, I said that even though all the averages that we track for you on the blog, save for the Russell 2000, were in the green, but the breadth was pretty ugly. For the S&P, it got even worse. It was about a break even. 262 of the S&P members were higher on the day. 240 were lower, almost 50-50, even though the S&P was up 39 basis points or 0.39%. The Dow was up a little bit, 0.15%, but 18 of its members were down. 60% of the Dow members were actually down on the day. The NASDAQ got better as the day wore on, but still more losers than gainers. And the NASDAQ was actually up 0.75% today. And with regard to the NASDAQ, I want to update you on the cumulative advanced decline line, and that's this chart here. This is, frankly, a very concerning chart. You can see on a cumulative basis, the advanced decline line has really rolled over, and that is the definition of a negative divergence against this uptrend line in price. The S&P 500, not so much. The S&P 500 AD line, I would say, is constructive. The NYSE, the New York Stock Exchange Index, it's a little bit bearish, but the NASDAQ is telling. And the NASDAQ, is where a lot of these big names that are really concentrated at the top of the S&P 500, for example, this is where many of them trade. And as you can see historically, and I did a little work on this for you, when it rolled over here, while the market continued to rise, we ended up with a 23% correction, 11% here, as we began to roll over. Not so much in that one. Clearly ahead of the big COVID decline, even though we hadn't had the pandemic right in here. This was telling us that something could crack this market, as was our overall macro assessment as well. Clearly ahead of this 13% drawdown. This was a warning, a little bit ahead of this 12% decline. So pretty consistently, when you see these divergences, it's not unusual to get some stress and some downside action in the market. This one is something that should be a red flag. You would want to respect this if we did get a break, say below this this trend line right in here, if you're a short-term trader. Okay, let's talk about the dollar. I promised in this morning's note that we'd do this on this update. So, folks, our longer-term view of the dollar is bearish. We don't think that the credit markets and the equity markets can stay as buoyant as they are, and I'll say bubbly, with the dollar trending higher on a consistent basis going forward. We think one of those three has to give, and clearly it's going to have to be the dollar if the powers that be have anything to say about it. Now, there is an army of economists and strategists who think the dollar is going to just continue to melt higher, and I get it. You look at the dollar relative to other currencies, you look at the interest rate differential, and we have a Fed that's, relative to the Eurozone that's looking like it wants to get a little tighter with monetary policy than they do. And the euro is like 50 to 60% of the counterweight to the dollar index, which is what we're looking at here. I would argue that longer term, there's probably better opportunity in assets abroad, given the valuations of the U.S. market and where we think the U.S. economy ultimately goes from here, relative to other economies. And we think that is going to attract capital to those other nations and therefore be a weight on the dollar and positive for those assets and equities in other places. We think it's a positive for commodities. But I have mentioned time and again that we will see periods of some strength, and boy, do we see an acceleration here. And so, we had this kind of real short-term channel in here. I circled this in green because we broke out of that. Here we had a buy signal on the MACD. Histogram looks supportive as well, and then the RSI as well too. However, when we back up and look at it a little longer term, there's your upward trend line, right? I guess you could go like this and say there's this big divergent high, right? And I say it's a divergent high because you have a higher high on the chart, but you have a lower high so far anyway on the momentum indicators, both the MACD and just still barely on the RSI. I will say these are on the verge of breaking through and burning through these divergences, but as we sit here today, it's still there. So this is the big decline off the peak, and this is where the Fed issued like 14 different swap lines with foreign central banks, and that really helped alleviate the pressure on the dollar, and so we had this nice big downtrend since then. So from here to here, here's where we bottomed. And now we look at these retracement lines. The first major resistance typically comes at the 38.2% retracement, and you can see right here, we finally made it up there, and it's resisted it like crazy. Now we've broken through it and stopped right at the 50% retracement, which is major resistance typically as we battle our way back up. And so it'll be interesting to see if we don't give some back on the dollar here over the course of the next few days. Okay, so let's look at the futures traders, and these are for non-commercial futures, right? So we call them speculators. In the dollar, first of all. So this means that on a net basis, traders are very bullish the dollar. They're very net long the dollar, right? And again, we think going forward that the dollar is going to be weaker. So when I'm thinking as a trader, I actually like to see this. I want to see the street thinking differently than we are. So if we're right, things begin to roll over and they start thinking we're right. Then they sell, and of course that exacerbates the move to the downside. In here, we had huge short interest, right? And I think I've mentioned to clients, I think I mentioned on the blog, the one thing I didn't like about my weak dollar thesis in the beginning of the year is everybody agreed, right? And sure enough, the dollar has come back out of it. In fact, here is the dollar chart for the year, right? So here's when everybody was bearish, and right from mid last year to right in here, they were right. And then sure enough, the market began to move on them, And so all these shorts began to cover, and you got the spike in the dollar. Everybody went long, and almost immediately it began going the other direction. Well, everybody's long in a big way, like we haven't seen since back here, October of 2019, right? 7 or 8 months before the dollar really began to roll over. So you really want to be in the minority if you're going to trade something like this, in my view. Okay, recall, I think it was last week, that we looked at silver, and I said we had what looks to me like a head and shoulders pattern, right? Your left shoulder, your head, your right shoulder, and then your neckline would go right through there, right? And then it's a reverse head and shoulders, which is bullish. So what tends to happen is you break through the neckline, which we did. Not a huge impulsive break with big momentum. So I'm beginning to wonder. And then it's not unusual to come back and test that neckline. Well, that's what's happened here the last couple of days. Now, silver futures are a little bit higher in the after hours, but for this to play out like it often does, what you need to see is that a passing of this test and then a bounce and then a move higher on a trend basis for a while. This is your 2-year daily silver chart. Remember, we talked about the battle between the bulls and bears in here all this time. And now we have this very bullish pattern, at least the way I draw it here. And that's a good look for silver. And of course, for lots of fundamental reasons, we like silver a whole bunch right here on a long-term basis. And we had a really nice rise, and we've had this long stretch of, we'll call it consolidation in here, where you consolidate or digest these gains. So we'll see. This is the best look I've seen in a while. We're thinking silver works nicely for the next several years, quite frankly. Next several weeks and months, of course, it's anybody's guess. A lot can happen in this crazy market in the short run. Thank you as always for watching and listening. Talk to you again very soon. Take care. Bye-bye.